Welcome everyone, and thank you for joining today's Fit for Learning webinar. As you can see here, we're going to be talking about taxes and investing. With tax season in full swing, we thought that this would be a great opportunity to be able to talk specifically about what it is that you need to be doing and thinking about when you're looking at your investing and how it may impact your taxes or your individual tax situation. And most importantly today, we want you to hopefully work to become more tax aware of your individual situation. And my name is Kyle Bingham. I am the Managing Director for Financial Fitness for Life, and joining me today is Josh Zeb. He is one of our financial education consultants. Collectively, we've had the opportunity to work with thousands and thousands of individuals, and so we always use these webinars as an opportunity to just be able to share some of the different experiences that we've had, but also it gives us a unique perspective on what is it that people are struggling with, what challenges are they facing when it comes to kind of balancing out their investing and becoming more tax aware. Here's a look at what we want to talk about specifically. First off, we're going to talk about some of the different types of investment accounts and then how those investment accounts could potentially affect the taxes that you pay. Then we'll move into talking more about the tax treatment of different types of investments. So you're balancing different investment accounts, but then also making sure that you're putting the right investments into those accounts. And then lastly, and quite frankly, throughout our entire webinar today, we're going to be sharing with you some different best practices and different strategies that you can start to deploy as you move forward with your own individual planning. And I think one important thing here that I want to emphasize, and then I'm going to kick it over to Josh, is that you don't need to become a tax expert. And what I do want you to strive for and what I challenge you to do is to become very aware of your individual situation. What are your goals? What are your objectives? And how are you taking this information that we present to you today and apply it to your own individual situation? And so with that, we're going to go ahead and tackle this first question. So Josh, how are different types of investment accounts going to affect the taxes that someone pays?
Yeah, no, great question, Kyle. I think this is really important nowadays, especially for those who maybe are more interested in investing, or perhaps they just opened a brokerage account for the first time. I think there's been a lot easier accessibility to those certain things. So we need to really understand and make sure we know the tax implications behind those as well. So as we get into the next slide, I want to go into a couple aspects when it comes to investment accounts that you might have already known, might have thought of, but rather if you have a brokerage account, if you have a retirement account, a qualified retirement account, or maybe you're just doing an individual retirement account, we really just want to make sure everybody just knows how these accounts operate, especially when it comes to the tax situations behind it. So with those bullet points you see below on the screen, you can see eligibility rules, annual contribution limits. I really consider those to be more focused on that qualified retirement plan aspect. So really understand how retirement plans work, especially when it comes to withdrawing the money. How are you contributing money in as well? Is it an after-tax contribution? Is it a pre-tax contribution? And then really knowing the maximum limit you can put in per year. And that for 2024, that's going to be $23,000, and it'll be an additional catch-up if you're over at the age 50. As we go down the list, tax treatment with investment earnings, that's a really important aspect, especially when it comes to those brokerage accounts. Kyle's going to dive into that a little bit more, but we really want to make sure we understand, specifically with the accounts we do have, how they're taxed on earning interest over time, or investment earnings over time. As we go down the list, we can see the tax brackets. It's a really big point when it comes to considering a taxable situation or not. So we really want to make sure we understand what tax bracket we're in. Are we on the edge of maybe going up a tier on the tax brackets as well? It's really important to just make sure we're aware of our situation, whether if we're filing jointly or separately, just kind of knowing the limits and knowing those tax brackets. And there's ways to kind of see and maybe lower your taxable income that we'll go into in the next slide.
Excellent. Thank you, Josh. And I think the takeaway here too is the idea that some of these different investment accounts have specific tax benefits that are associated with them, but with those tax benefits come different rules, guidelines, and eligibility. And so it's important that you understand the ins and outs of what that eligibility and what those guidelines look like. I mean, a real common one is contribution limits, right? Because of some of these tax benefits that you get with tax deferred growth or tax free growth, they're not going to let you put just as much money as you possibly can into that. There's limits, so that there's kind of a guardrails around that. And just like Josh said, we're going to focus a lot on tax treatment of those investment earnings here in just a little bit. And so kind of moving on, Josh, why don't you walk through when taxes apply based upon which type of investment account a person is using?
Yeah, no, absolutely. And you can kind of see the three different account types we have on the screen: taxable, tax deferred, and tax exempt. You might have heard of all of these before. Some of you might have all of these personally, or might have one or two of these. So it's really important to kind of understand when it comes to our accounts is how are they taxed, if they are, and when does that take effect. So with the taxable accounts, again, those are considered more of the brokerage account. Those are going to be taxed on the investment earnings. The taxes are going to be due when the income is earned. So capital gains, interest, dividends on those investment vehicles. So really making sure you understand the investment options you have in those brokerage accounts, if any of those apply: capital gains, interest, and dividends. The important thing to know here is going to be with the capital gains, the long-term capital gains, 0% if your ordinary income is less than $47,000, and if you're filing joint, that's going to go up to $94,000. Really important to know that. Kyle's going to go into capital gains in a couple slides here. We'll go down the list to tax deferred. This is probably the one that most of us have heard of before. This ties in a lot with the retirement accounts that we might have, a traditional 401k, or maybe if we are doing something on our own, a traditional IRA. Taxes are going to be deferred. You might hear the phrase pre-tax or pre-tax contribution that falls into this category. The taxes are due when you start withdrawing this money in retirement. Now, what's really important here is knowing that the taxes due is going to be ordinary income. So if you delay the taxes until retirement, you withdraw a portion of your money, that's going to be considered earned income or ordinary income for your sake. And then lastly, we have tax exempt accounts. Another phrase or word to kind of illustrate this is Roth. And most of you probably have heard of Roth before. You can have a Roth 401k perhaps, or a Roth individual retirement account, or IRA. The really important thing here is money that's going to go in has been taxed, so your contributions have been taxed. When you start the contribution process, the investment earnings are going to be tax-free. So this is one of the benefits of the Roth or tax-exempt accounts. The investment earnings will be tax-free. And when are taxes due? Well, all withdrawals are tax-free, so that's a great thing to think about. But the important thing here is going to be the 5-year window. So you can't withdraw any of your earnings tax-free until you've had that account for about 5 years. So really important to know, especially for those who do have these tax-exempt accounts, is just making sure you know when you started it and know when that clock started to tick. So again, 5 years is the name of the game for these tax-exempt accounts.
Excellent, great. Thank you, Josh. And so now what I'd like to do, I want to tie in now some of the different types of investments. And we're going to answer the question, how does the tax treatment of different types of investments impact my tax bill? And so first thing I just want to talk briefly about are some of the different ways that your investments earn income. The first one is going to be through interest, right? And I'm sure most all of you are familiar with that particular type of income. It would be something that's being paid either from a bond or some other type of debt instrument, and you're going to be getting periodic interest payments. And oftentimes that particular income is going to be taxed as ordinary income. Another common type of investment income that you'll see, especially for those that have individual stocks or different mutual funds that have a lot of individual companies, individual stocks within that mutual fund, are dividends. You have ordinary dividends, and then you also have qualified dividends. Ordinary dividends are going to be treated again like normal taxable ordinary income, but then with qualified dividends, you are getting a more preferential tax treatment there as well. And then the third point, or third way to generate growth or income, if you will, is capital appreciation. And that's what I think most all of you are familiar with. You buy something at a certain price, that investment goes up in value, you've had that appreciation, then you sell that, you realize a capital gain. And that's what we're going to take a look at right now, are understanding that there's different types of capital gains, and then we're going to get into a little bit about being strategic in terms of how do we manage these different types of capital gains. You have short-term and long-term gains, and you can see here on the chart that if you've profited from the sale of an asset, if it's been less than a year, it's short-term, longer than a year is long-term. And when you have realized that gain, you are going to have to pay a certain amount of money in the form of a capital gain tax. And then down at the bottom, there are going to be different capital gains tax rates that are assigned. And if you go in the middle column there, when you're looking at your short-term capital gains, that particular tax rate could be up to 37%. Now, if you move to the right, and now you're looking at your long-term capital gains, we're starting to see lower tax rates, 0, 15, or 20%. And so when you hear this idea of favorable long-term capital gain tax treatment, this is what it is referring to, that when you do realize a capital gain, it presents an opportunity for you to be able to have a tax benefit, meaning that you're going to be able to be paying your taxes at that lower rate. And so now we're starting to try to balance these two, this idea of getting the right types of investment accounts, but then also factoring in the different types of investment income that we have based upon the investments. And now we've added this other layer of managing our capital gains and trying to take advantage whenever possible of that long-term capital gain tax treatment. Moving a little bit further now we're going to look at asset location. And so with asset location, the goal is to be able to basically minimize the taxes on investment income and capital gains while maximizing your after-tax returns. So a couple of points here, and we'll get into a little bit more of the weeds on different types of investments and their tax efficiency. So let's start on the left-hand side where we've got least efficient. Here you've got taxable bonds, taxable bond funds, you have REITs, high turnover funds. The takeaway here is what? Well, we know that with bonds, they're going to be paying out periodically that interest income. Oftentimes that's going to be ordinary income. And because of that, these types of funds are going to be more in that least efficient category from a tax standpoint. So that means, where would we put these types of investments? Well, it might make more sense to go into a tax deferred or even a tax exempt account like Josh talked about earlier. Why is that? Because we're deferring those taxes. So even though that income is coming in monthly, quarterly, whatever it may be, we're able to defer paying taxes on that because of the benefits associated with those traditional and Roth accounts. Moving on to the middle section, now we're getting a little bit more tax efficient. Now we're looking at actively managed stock funds, total bond market funds, and balance funds. So now these types of investments are going to potentially still have some of that interest income that's coming in perhaps, but now they're also starting to potentially leverage long-term capital gains, and we may have some of that type of income coming in as well. And so as a result of that, we could say that it is getting more tax efficient, but not to the point where we necessarily want to select an account other than, again, tax deferred or tax exempt, because the takeaway always is here, you want to have exposure to different types of investments, but if we can avoid having to pay high tax rates and generate a lot of short-term capital gains, that's where these types of accounts really benefit. And then if we move over to the right-hand side, now we're looking at what are going to be most efficient. You're going to have municipal bonds, municipal bond funds, tax managed funds. There's a lot of tax managed funds out there that their specific objective is to try to minimize the taxes while maximizing the rate of return. And then also equity index funds. So here is where things are changing a little bit, because now potentially with these types of investments, it might make more sense to put those into a taxable account. I'll share with you just a really quick example, because in addition to these investments, also, if you are an individual stock trader, you like individual equities, individual companies, and you like to hold those for the long term or longer than 1 year, that's where putting those individual stocks into that taxable account would potentially make sense, right? Because we're going to hold that for longer than a year. So there's going to be a whole year period where we're not going to trigger any taxable events. There's not going to be any short-term capital gains. But now once we've passed that year mark, now if we decide to sell that individual stock, what just happened? The taxable event was a long-term capital gain. And again, we go back to that more preferential tax treatment. And so that's one of the benefits of including a taxable account as a part of your broader or overall strategy and your saving strategy and investment strategy that you might have with your tax deferred or even your tax exempt accounts. So we've talked about a couple strategies already that you have getting your investments into the right accounts. It's also just having a good general awareness of the different types of investments that you have, making sure they're in that right location. We talked a little bit about managing capital gains, short-term versus long-term, and how long-term capital gains could potentially be a great part of our investment strategy and using a taxable account perhaps. Now, I want to go back to asset location here for just a moment. And again, this is a very basic high-level example. So if you want to take that step of making sure that you've optimized the asset location of your investments, if you look at the pie charts on the top, these are the three accounts that we've been talking about today. You've got a taxable account, a traditional account, which could be an IRA or a 401k, and then you have a Roth account. Again, it could be an IRA, it could be a 401k. This particular investor has a 50-50 asset mix, 50% into stocks, 50% into bonds. And the question is this the best location for all of these individual investments? Well, now let's tie in what we're talking about today. First thing that comes to mind is, well, with the taxable account, we want to try to avoid having too much in terms of short-term capital gains and income that's going to cause us to have to pay more taxes in each individual tax year. So the first thing that you see happening here is we're going to take that 50% of stocks from the traditional account or even from the Roth account, and we're adding that to the taxable account. Now we have 100% in stocks. Now, as we're investing in those individual stocks, once a year has gone by, as we start to sell off some of those different stocks, we're triggering long-term capital gains now, and we're getting that better tax treatment. And then when you move over into the traditional account, you can see that we took the bonds, that 50% bond exposure from the taxable account, and pulled that over into the traditional account, because what we're doing here is we're deferring taxes, right? That we know that the bonds or bond funds are potentially paying out income, but we're able to defer that because of the benefit of that being in a traditional 401k or IRA. And again, you could kind of apply the same type of logic to the Roth. The big difference with the Roth being that it would be potentially tax-free growth, and then even in retirement, when you're taking that money out of the Roth, there are not going to be any additional taxes that you're going to have to pay on that. Josh, kind of pointing it back to you, what other points would you like to make with regards to kind of strategy as folks start to approach this idea of asset allocation, investment selection, and taxes? What might you also recommend?
Yeah, no, that's a very good point here, and I'm really thinking about those people who are close to retirement or if not in retirement. You can see that Roth account on the side there, where you really don't have to do much to make yourself in a better tax situation because you've already paid taxes on it. So if you're able to contribute to a Roth IRA or 401k to kind of give you a little bit of different income maybe in retirement, where maybe you have a couple of different levers where you can withdraw from, I think that's a big deal. And if you're able to take advantage of that situation, if it makes sense for your taxable situation right now, that's something to maybe think about.
Yeah, Josh, that's a great point. I love that idea of tax diversification. That if you throughout your entire life, your entire career, all you ever did was save in your 401k, all you ever did was pre-tax contributions, that's not a bad thing. But just know that there's not as much flexibility that you have in retirement. That if it's just that one account, any money that you're withdrawing out of that account is now going to be taxed as ordinary income. But then as you start to fill up those other buckets, as Josh talked about, maybe putting in some Roth contributions, maybe adding a taxable account as a part of your overall portfolio or investment strategy, now you have more flexibility with how you're withdrawing the money and the taxes that you're going to be paying in retirement. It could be a combination of 50% from a traditional IRA or 401k and 50% of what you need coming from the Roth IRA or Roth 401k perhaps. So again, that's an excellent point to remember with that tax diversification component. So what are the next steps? And again, I said this at the onset of our conversation today, is you don't need to become a tax expert, but there are some easy next steps that I think each of you can take. And that first one being, just make sure that you understand the benefits of some of these different tax advantaged accounts. You're going to be getting tax deferred growth or even tax free growth. And so that eliminates a lot of some of this confusion about paying taxes yearly, long-term gains, short-term gains. And so take the time to understand those types of tax advantage accounts. And again, I'd encourage you to look, if all you've ever done maybe were pre-tax contributions, maybe look at Roth contribution perhaps as a way to enhance your saving strategy. The second piece, finding the most efficient asset location. So think about your investments, think about that tax treatment, and confirm whether or not those investments are indeed in the right spot. And the bullet point here that talks about total return. We don't just want to look at, okay, we started here at this price, we ended here at this price, this was our rate of return. We have to be taking into account some of those other variables, whether it's other income that you might be getting through interest payments, dividend payments, or capital gains, but really looking at as a part of your overall strategy. You hear us, and for those of you that have attended a lot of these, we talk all the time about the benefit of even just saving 1% more per year. And over a 20 or 30 year period, that could equate to thousands and thousands of more money in retirement. I would also challenge you to look at that from a tax efficiency standpoint. Imagine if you could increase your after-tax return by 1% or maybe even more, and you're applying that same logic that now you've gotten more tax efficient. Now your money's growing more tax efficiently, and you're going to have a bigger, larger nest egg once you do retire. Understanding capital gains and managing those capital gains, that's that third component. Big takeaway here is hopefully you understand now what is meant by favorable tax treatment when we talk long-term capital gains, okay? We also have other strategies that we didn't get into today, like tax loss harvesting. That's another benefit and another strategy that some people deploy within a taxable account. If you have a taxable account, you have one investment that's done really well and you locked in and realized your gain, but you have another investment in there that it's not doing well, you can actually sell that investment, realize that loss, and then that loss can offset some of the gain that you receive from that other investment. And again, tax loss harvesting is something that people use as a part of their overall tax strategy as well. And then lastly, and again, this is something Josh alluded to this already, optimize your withdrawals, tax diversification, have multiple levers, have multiple buckets that you can pull from in retirement so that we don't have to be fearful that if tax rates go up or however tax rates might change, we still have the ability to manage that in retirement because we have some Roth money, we have some traditional money, we're taking into account income and investments that we might have in a taxable account as well. That's really the four main points here that I want all of you to be able to take away from today. As always, we are here to help navigate you through some of these different topics, and taxes is one. It can be complex, it can be a little bit overwhelming, so feel free to reach out to us. You can scan that QR code right there. One of our advisors or Josh would be more than happy to sit down and discuss what you've learned today. And again, this is always complimentary, so feel free to reach out. And also, for those of you, and I know many of you are already working with your advisor, I would take an opportunity to reconnect with your advisor while we're still in tax season to see about possibly using some of these strategies that we talked about today as well. And for those of you, if you haven't done so already, please take a moment and register for our April Fit for Learning webinar. We're going to be talking about what are the steps that you take to establish emergency funds. Time and time again, you know, when we complete the different surveys that we do, I know many of you are always asking about different ways to save, different ways to budget, different ways to build up your nest egg. And so again, for next month, this is going to be a great opportunity for you to be able to make sure that you're following the steps that you need to take to get that emergency fund built out. And again, that's just another topic that we can add into to help to complement your broader financial plan that you have. And with that, I just want to thank you all for taking a little bit of time out of your day to be here. Again, best of luck to everyone. Feel free to reach out if there's anything that we can do to help, and have a wonderful rest of your day. Bye-bye.